You want to invest in the essential materials that run the world: energy, wheat, precious metals. But actually buying them is a logistical nightmare. Imagine an industrial delivery truck backing up to your apartment door to drop off 5,000 bushels of corn. Storing raw materials requires leasing massive silos, paying for specialized insurance, and managing thousands of heavy steel barrels. It is entirely out of reach for a regular investor. Yet when the cost of living spikes, these are exactly the assets you want to own. When prices at the pump or the grocery store go up, the value of these raw materials goes up with them, protecting your purchasing power. Fortunately, you don't need to rent a warehouse to capture that price growth. There is a financial workaround built exactly for this. It's called a commodity index fund. You can buy it with a single click in a regular brokerage account, just like a stock. This fund gives you a diversified slice of the entire global raw materials market. You get the financial benefits of owning the assets without ever having to figure out how to operate a commercial grain elevator. So, how does a fund track the price of wheat and oil if it refuses to actually touch them? It starts by following an index. Think of the index as a strict, fixed recipe that tells the fund managers exactly what to buy. This recipe dictates precise proportions, like 30% energy, 15% metals, and 10% agriculture. To fill those slices, the fund doesn't buy physical barrels or bushels. Instead, it buys paper contracts. These are called futures contracts. You can think of a futures contract as a simple IOU ticket. It guarantees that you will buy a specific amount of oil or gold next month, locked in at today's price. By holding on to a massive stack of these IOU tickets, the fund captures the exact financial gains of rising commodity prices, completely sidestepping the need for physical delivery. There is a catch to this strategy. These tickets eventually reach their expiration date, and when they do, the promise becomes due, meaning physical delivery is imminent. To avoid taking delivery, the fund has to play a game of hot potato. Right before the deadline hits, the fund managers sell the expiring ticket and immediately buy a new one that expires the following month. This chart shows contango. The new monthly ticket costs slightly more than the expiring one. Repeating this swap forces a small loss each time. Over a year, this continuous swapping creates a persistent drag, eating away 2 to 5% of the fund's returns. This hidden drag acts like a mandatory subscription fee for the luxury of not storing the goods yourself. It perfectly explains why your fund's profits will trail slightly behind the actual price of the raw materials. If this strategy constantly drains away a few percentage points of your profits, why do investors use these funds? A traditional portfolio of stocks and bonds is entirely made up of paper financial assets. When a crisis hits or inflation spikes, those paper assets often lose value together. Raw materials are tangible goods. Because they move independently from the stock market, their prices frequently surge precisely when there is widespread economic panic. Willingly paying that hidden monthly fee is simply the cost of buying portfolio insurance. You accept slightly lower returns in exchange for a vital financial shock absorber when traditional markets panic. A commodity index fund isn't designed to make up your entire retirement account. It serves as a small, targeted shield to protect your savings when the cost of living climbs. Even with the hidden costs of tracking prices on paper, it remains the most practical way to armor your wealth against inflation, all while keeping your living room perfectly oil-free.